All right, let's talk about why most crypto projects are, well, pretty much doomed. And I'll tell you right now, the reason is probably not what you're thinking.
Let's just kick things off with a number. A really brutal, honest number. It's estimated that something like 95% of all crypto projects fail. Just poof, gone. The big question is why?
Now, your first thought is probably scams, right? Rug pulls. And look, yeah, those are out there, for sure. But that's not the real story here. It's not why the vast majority of them go under. The truth is actually a lot more fundamental.
Here it is, plain and simple. They fail because the math is broken. Their whole financial model, it's just broken, right from the very start. It's not some evil plan, it's just really, really bad math.
Okay, so let's dig into the real reason they fail. What's at the absolute core of this problem? Well, it all kicks off with a massive misunderstanding of, like, the most basic concept in Business 101, revenue.
You know, in any normal company, revenue is simple, right? It's the cash you get from selling a product or a service that people actually want to buy. But in crypto, a lot of projects get this twisted. They think printing tokens out of thin air and selling them is revenue, but it's not. That's a one-time cash grab, and it comes with a very heavy price. And this is where the trap is set. See, that initial cash they raise, it has to pay for everything. Developers, marketing, you name it. So what happens when that money starts to run out? If there's no actual product bringing in fresh, real cash, they only have one move left: sell more tokens. And that just creates this constant, crushing downward pressure on the price.
So let's put this broken model side by side with a traditional company. Honestly, the difference is, it's night and day.
Think about it. A normal company, it's trying to create a cycle of value. It makes cash, pays its expenses, and with any luck, it keeps some profit. A crypto project, on the other hand, often gets stuck in a death spiral of dilution. It issues tokens, sells those tokens to pay the bills, and just burns through cash until there's nothing left.
And look, this model isn't just a little bit flawed, it's pretty much guaranteed to collapse. Why? It all boils down to a really simple, totally unavoidable imbalance of supply and demand.
Just take a look at a typical token allocation pie chart. You'll see these huge chunks, right? Often like 45% or even more, are held by the team and the early private investors. And these folks, they aren't necessarily in it for the long haul. They're on what's called a vesting schedule, which basically means their tokens get unlocked in batches over time.
Okay, to really get a sense of how big this problem is, let's just do some quick back-of-the-napkin math. Say a project has 1 billion tokens, and 45% of that goes to the team and investors. If they have a pretty standard 5% monthly unlock, that means 22.5 million new tokens could potentially hit the market every single month. That's a flood.
So that brings us to the 22.5 million token question, right? Who on earth is buying all of these new tokens, month after month after month? And the simple, honest answer is pretty much nobody. The demand from new people coming in just almost never keeps up with this constant, relentless wave of new supply.
Okay, so you're probably thinking, if the math is this bad, why doesn't everybody see it? Well, here's the thing. In the crypto world, financial transparency isn't exactly a top priority. In fact, it's often the opposite.
I mean, try to do your due diligence on a crypto project like you would a real company. You'll hit a brick wall fast. You're looking for an income statement? Nope. A cash flow statement to see how fast they're burning money? Good luck with that. What you will find is a really slick, fancy roadmap filled with a bunch of promises about what they're gonna do in the future.
Let's just be super clear here. In any other industry, if a company just flat out refused to show you its financial numbers, that would be a gigantic red flag. Investors would run for the hills. But in crypto, this total lack of basic financial discipline has somehow become, well, the norm.
All right, so I know that was a lot of doom and gloom. So is there any hope? Are there any good projects out there? The answer is yes, absolutely. They're just rare, but they are out there, and here's how you can start to spot them.
So here's what you should be looking for. Think of it like a checklist. First, does the project actually earn real money? We're talking dollars, stablecoins from a real product. Second, is the token supply pretty much fixed, or at least growing very, very slowly? Third, can you find the vesting schedules for the insiders, clear as day? Fourth, do they tell you their cash runway? Like how many months they have before they run out of money? And finally, is the token's value actually tied to something that generates cash? These are the hard questions, but they're the ones that will help you find the survivors.
And this really brings us full circle, back to the main point. Most of these projects, they're not trying to scam you. The failure isn't born out of malice. It's born from a complete fundamental lack of understanding of how a business works. Revenue, cash flow, dilution, it's just financial illiteracy, plain and simple.
So if there's one thing you take away from this, let it be this. When you see a token's price just slowly bleeding out day after day and then suddenly collapse, that's not random. It's not just the market. It is the predictable, absolutely inevitable result of a broken financial model. Because at the end of the day, hype, that fades. But the math always wins.